Let's talk to Patrick Reid. He is the co-founder of Adamis Principle. Very good morning to you, young Patrick, and
Morning.
welcome to your international debut here at Core Finance. Right, you've sent 4 thought-provoking slides. Without further ado, let's take a look at them. The first one, the ICE of Bank of America, US high-yielding CCC or below option-adjusted spread. What on earth is that all about?
Yeah, it's a bit of a mouthful, isn't it? Basically, what this is, it's a great measurement on appetite for risk. So yield-hungry investors are basically ignoring the Fed. They are still up for buying bonds, and just 4 hikes, absolutely not bothered. So 3 base case, but they're in some ways blowing off the Fed because they're still hungry for yields, and this is basically the spread between zero risk, i.e. treasuries, and high yield corporate debt.
Okay, so again, an extraordinary one-way traffic at the moment, right?
Absolutely. I mean, I always see this as a good thermometer for risk.
Yep.
And essentially, the spread in between zero risk and high risk is if you're on an oil rig, it would be like danger money. And obviously, it's still really, really low. You can see the peak there. That was the China credit crisis. And, we're still very, very low, currently around 3%.
Wow.
The key worry for me on this chart is the appetite. I mean, there's a lot of corporate issuance. CVC Health have just issued a 60 billion issuance and snapped up, oversubscribed. The key thing here is if the Fed does raise 4 and some, the chances of default are very real.
Understood. Okay, well, let's move on that happy note to the Euro US dollar daily chart. I've had a technical analyst on this morning suggesting that this is more likely to go south than north. Are the fundamentals stroke technicals for you suggesting the same scenario?
Well, look, I mean, it is what it is. We are consolidating at the highs on the daily. You had Draghi, he giveth in the statement, he taketh on the Q&A.
Yeah.
So, we're still consolidating above the 38%. We're still above the 2 key moving averages, the 100-day and the 200-day. So for me, it's a firm buyer of dips. 2 key levels to watch out for.
Yep.
121.65 and 121, the big figure.
Okay, so you're bullish on the Euro US dollar.
Having said that, 125.50 is a key monthly moving average around that. So I'll be selling there too.
Understood. Okay, certainly you're a range trader. Okay, let's move on to the third slide. We've got the investment grade bond yields start to respond. What is this telling the audience?
So this is really interesting because this is basically the quality junk.
Yep.
And you're kind of getting.
Isn't that an oxymoron? Quality junk.
Yeah. Well, this is it. You could talk about this on another episode, but this is basically you're getting closer to actual treasuries, and you have to ask yourself a question. With 10-year toying around 2.83%, you're getting a response here. So are you going to go for this one and have more risk, whereas you could just go for zero risk?
Yeah.
So it's just an interesting reaction to the more quality junk.
Okay. Clearly, with the 10-year money being at sort of 2.83% there or thereabouts, okay, the spread differential doesn't strike me as...
Absolutely.
I know which way I'd be. Let's put it like that.
Exactly.
Okay, so let's move on to the last slide in this segment. Okay, the corporate bond market still in denial. What are your thoughts here?
Yeah, I mean, this reinforces slide 1. This is the AA spread, so it's quality, but if you just compare it in a relative sense, it still is quite low. In 2007, nobody would ever mention the D word, which is basically default.
Yep.
And now look at where we are. So I'm not, this is a key word for me, default. And if you get massive juggernauts stretching, this is going to be, indicative of the future.
Wow, that was all watch this space, I think, in summary. Patrick, a very good debut.
Thank you very much.
For your time.
Thank you.